Financial analysis is the bread and butter of finance work. And in this module, you'll learn how to use AI to make your analysis faster, more thorough, and more insightful. By the end, you'll be able to use AI for ratio analysis and interpretation, conduct variance analysis with AI assistance, generate insights from financial data, build effective analytical prompts, and avoid the common pitfalls people hit when they lean on AI too hard. The key idea running through everything is simple. AI is brilliant at interpreting numbers and synthesizing data into a clear story, but it should never be the one calculating those numbers. You lead on the math and the accuracy. AI helps you make sense of what it all means. Let's start with ratio analysis. Traditional ratio analysis follows 5 steps. You calculate ratios, compare them to benchmarks, identify significant variations, interpret what they mean, and draw conclusions. AI is most useful on steps 3 through 5. It can quickly synthesize liquidity, profitability, efficiency, and leverage ratios into coherent analysis. But steps 1 and 2, the calculations and data accuracy, stay firmly with you. Never trust AI with your math. When you prompt it, give it the company name, the industry, your key ratios with prior year figures, and industry averages if you have them. Then ask for specific things, key observations and trends, areas of strength, areas of concern, likely causes for big changes, and questions to investigate further. That last one, the investigation questions, is often where AI delivers the most value. Let's see this in action with ABC Manufacturing, a mid-sized industrial equipment maker. You feed AI the ratios you calculated. Current ratio fell from 2.1 to 1.8. Quick ratio dropped to 0.9. Inventory turnover slid from 4.5 times to 3.2. Gross margin slipped 3 points. Operating margin fell from 12 to 8%. And debt to equity jumped from 0.5 to 0.8. The AI connects the dots. The falling inventory turnover plus the weaker quick ratio suggests inventory is piling up, and it's moving against the industry average of 5 times. Margins are compressing, which could mean rising costs or pricing pressure. And the rising leverage plus falling profits increases financial risk. Then it asks the right questions. What's driving the inventory buildup? What was the new debt for? And are receivables aging? That's the real payoff. AI is especially strong at variance analysis because that work is all about connecting data points and explaining relationships. For budget variances, give it your revenue and expense line items with actuals, budget, and variance percentages, plus any business context like economic conditions or known events during the period. Then ask for the most significant variances, the interconnections between them, the likely root causes, and discussion points for management. AI can also help decompose variances. Say your sales variance is unfavorable by $500,000 with volume down but price up. AI can walk you through splitting that into price and volume components and explain what each one tells you. But here's the rule again. You verify every calculation it provides, apply your company-specific knowledge, and validate its explanations against what actually happened. AI also shines at turning multiple data points into a trend narrative. Give it several years of revenue, margins, expenses, and net income, and ask what story the numbers tell, what the key concerns are, what's driving the patterns, and what management should answer. A classic example is revenue climbing steadily while margins erode and net income quietly falls year after year. AI can surface that hidden squeeze. You can also ask it to scan for red flags, like inconsistencies between metrics, ratios that look unusual for the industry, or signs of financial stress. And for peer comparison, give it the same metrics across several competitors and ask which one looks operationally strongest, what trade-offs each is making, and what extra information would sharpen the analysis. Same discipline applies. These are starting points, not verdicts. The more you do this, the more you'll want a reusable prompt library. Effective analytical prompts share 4 parts. First, context setting, the company and industry, the time period, and the purpose. Second, data presentation, clear, organized numbers with comparative figures and relevant qualitative context. Third, a specific request, what type of analysis, what format, and what questions to address. And fourth, output specification, the structure you want, the level of detail, and the audience. Keep a handful of go-to prompts ready. For example, a quick ratio interpretation prompt, a revenue quality prompt for when receivables and inventory outpace sales, a margin analysis prompt, and a cash flow versus income prompt for when net income is positive, but operating cash flow is negative. Refine these over time and they'll save you real effort on every analysis. Before you go, keep 4 pitfalls in mind. First, never trust AI math. It pattern matches, it doesn't compute, so calculate ratios and variances yourself and double-check any number it gives you. Second, missing context. AI doesn't know your company's recent events or decisions, so add that context and validate its explanations. Third, over-reliance. AI sounds authoritative but can reach wrong conclusions, so treat its output as a first draft and apply your judgment. Fourth, generic analysis. Without specifics, you'll get textbook filler, so always ground it in your real situation. Now it's your turn. Take a familiar set of financials, build a prompt using the structure we covered, and try it right now in the interactive prompt playground on this lesson page at Free Academy AI, or paste it into ChatGPT or Claude. See what it surfaces, then refine it.